Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.
Hello and welcome to Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Geoffrey Dennis, independent emerging markets commentator, joining in. Welcome to the show, Geoffrey, and it's a pleasure to speak to
Thank
you.
you.
My first
Thank you.
question coming to you is currently we had a lot of global events that were lined up that could be having an impact on markets across. Firstly, you had the US presidential elections that was really
hmm
dicey between Biden as well as if you talk about Trump. However, finally now Trump has accepted Biden's victory. You had the Fed meeting as well that was, we saw what came out of it. And globally, if you see from Europe, you had Brexit that is posing concerns. How do you see
hmm
these global events impacting markets from your on? Because currently we are seeing good highs, record highs that are being broken.
hmm hmm I think the record highs being broken are being driven by a couple of major things. First of all, the extremely supportive monetary policies that you're getting around the world from all the major central banks, indeed also a lot of emerging market central banks as well, with absolutely no prospect that these policies will be tightened anytime soon. So you have zero interest rates or close to zero interest rates in many, many countries, quantitative easing, of course. And I think that has led to a lot of money moving into risky assets, especially equities. At the same time, of course, bond yields are low around the world generally, especially in the developed world. And that means investors are saying, well, what's the alternative to putting money into equities when you've got bond yields that are so low? So I think that is a major factor, clearly, and that's been in place, of course, for many months now. But I think what's been happening particularly recently is there's suddenly some excitement, of course, about vaccines because of the news from initially Pfizer and just this week from just today, actually, from Moderna about the efficacy of their anti-COVID-19 vaccines. And this is leading investors to hope and believe that the upturn, the recovery of the global economy may not be as far away as was previously feared. So I think those are the two main drivers. Obviously, there's the politics across the globe with clearly the presidential transition, which we presume is underway in the US to President Biden. And as you rightly say, Brexit's a gigantic uncertainty overhanging in the UK economy. But for me, the major drivers right now and over recent weeks of these very strong markets is monetary policy support, some fiscal policy support, and optimism that vaccines will lead to an earlier economic upturn than might have been believed a few weeks ago.
Right. So, Geoffrey, with all of this, how would you really place emerging markets right now? Because if you talk about valuations, they are really expensive.
Mhm. You are getting some good tailwinds right now for emerging markets. Yes, they are on the expensive side. Of course, they are very cheap compared to the developed world, especially the US, and I think that should be borne in mind. So equity markets worldwide are pretty expensive, frankly, but and EM is not as expensive as the US, so that's one point to make. But you're getting some tailwinds behind emerging markets at the moment from a number of areas. Number one is the rotation you've seen recently from some of the growth stocks back into some of the cyclical stocks on the optimism about the global economy recovering sooner rather than later. And of course, also from the weaker dollar. Now, it's been one of my major points that I've made for many years on a consistent basis, which is that the weaker dollar has always been one of the very positive aspects, positive drivers of the emerging market asset class. So that's been helpful also. But I think the danger is here is that with this rotation we've seen towards more cyclical stocks and towards more risky markets, with markets in November such as Brazil and Russia and Turkey and South Africa and Mexico doing very well, is I think we may be getting a little bit ahead of ourselves, because it'll be quite some time, I think, before we start to see a sustained economic recovery. And of course, part of this rotation has also been driven by the problems we've had in China, in particular over the, let's call it a delay to the Ant Financial Group IPO, which has led to a major adjustment of sentiment towards China. So I think we've got to be a little careful about chasing these risky markets in EM too rapidly. But I think the asset class as a whole, which has done pretty well in 2020. I mean, if you look at the numbers, this doesn't look like a year where we've had a major pandemic or a dramatic collapse in growth, very deep recession, albeit a short one. It just looks like a sort of ordinary year. EM's up about 8 to 9%, DM's up about 8 to 9%. I do think the asset class has got some momentum behind it, but I'm a little nervous about encouraging people to chase some of these risky markets, because my view here is that it's going to take a while before you start to see a really strong, sustainable global recovery, or if you like, before we see the end of the pandemic.
Right. So, Geoffrey, we spoke about US elections. With that, we had the recent Fed monetary policy as well. Do you think that the commentary that we've heard from the Fed is something which could probably be positive, for emerging markets, taking how the dollar is performing into consideration?
Yes, definitely. I mean, the Fed Chairman Powell could not be clearer. He believes, he's argued that interest rates will stay low for a very long period of time. He's argued that QE will continue for a very long period of time and possibly will be extended to other assets, or indeed the amount of QE, the volume of assets bought could increase. So I think we're on full green lights, if you like, in terms of the ease, the accommodating nature of Fed monetary policy. And I don't think that's going to change anytime soon. You're going to need a very strong, perhaps I should use the word sustainable economic recovery before the Fed is going to think about withdrawing any of this. And I think that will ultimately translate into further weakness of the US dollar. My view has been for some time the dollar is overvalued. I think it's still overvalued against other major currencies such as the euro, and probably some of the emerging market currencies like Brazil, like Russia, like South Africa, India, some of the other majors as well. Maybe not Mexico, maybe not Turkey. Some of these currencies got oversold. And I think that you'll see a weaker dollar over the next 6 to 12 months, unless you get a suddenly much more dramatic recovery of the US economy than we anticipate. And that will be very supportive for emerging markets. So I think the point I want to make here is I think that on a 6 to 12 month basis, I think emerging market equities can outperform developed markets. I'm just reluctant to chase some of these more risky markets, which have done very well recently, and would frankly rather go back to some of the growth markets, some of which have done well in November as well, like Korea. It's only really been China that's been quite weak. So I think it's the allocation within emerging markets that I'm more nervous about, but I do think the outlook for the asset class looks quite good on a 6 to 12 month basis.
Right. So taking the liquidity into consideration in Europe and the US with the loosened monetary policy right now, do you see a lot of funds that could be diverted into emerging markets? And if yes, which asset class would it be between equity as well as debt, taking into consideration how bond yields are performing as well right now?
Yeah, it's a great question. I mean, first of all, I think that the same is true, as I said about the Fed. I think the same is true about the European Central Bank as well. They're going to remain very accommodating, and the Bank of England and the BOJ. So I think this is all going to continue for a while. Now, I think that will pull more equity funds into emerging markets. Now, to be fair, all the work that I've done historically shows that these flows into emerging market equities tend to react to the markets rather than drive the markets. So the flows tend to, start to move more aggressively towards emerging markets when you're starting to see a little bit of a rally. So I think what you've seen in 2020 will gradually encourage more money coming towards emerging market equities. Now, the challenge versus bonds is very interesting because I made the point earlier on that developed market bond yields are very low. Now, emerging market bond yields are also low. They're just not as low as developed market bond yields. So I think some of the money will head into emerging market debt, possibly mainly into local debt, local currency debt. No doubt at all that one of the reasons why China has done so very well this year, China's up about 24%, the Chinese equity market this year in dollars. So it's massively outperformed even the US market this year, has been because you've seen flows going into not just equities, but into bonds because bond yields are higher there. So I think countries that are perceived to be good credit risks, where bond yields are decently above zero or decently above 1% or something of that order, the sort of bond yields you can get in some of these developed markets, some of that money may go into debt markets. But I happen to also think that if we're talking about an economic recovery eventually perhaps being more sustainable and more significant, say, the second half of 2021 or into 2022, I think equities will catch some of that as well. Now, if I can just make this point as well, Hiral, if I could, because this is very important. To me, the biggest single risk to equity markets worldwide, and I've argued this many times in the media, in print as well, is a sharp fall in U.S. bonds, in the U.S. bond market. In other words, were you to see a sharp backup in U.S. yields, which are already back up to about 90 basis points for 10 years, compared to a low of about 60, 65, I think that would change the dynamics considerably because it would suck some money out of equities into bonds. And so I think you've got to keep an eye on the risks that perhaps higher inflation down the road because of all this monetary easing, or perhaps a pickup in economic growth eventually could put bond yields under upward pressure. Now, that doesn't mean equities won't do well, but in that environment, I think once that were to happen, I think you'd find that equities would be a preferred asset. But frankly, I'm watching those bond yields very carefully because I think they are going to be a signal for financial markets to struggle a little bit when that happens. Although, frankly, I don't think that's going to happen very quickly.
Right. So, Geoffrey, with this, if you have to look at India again right now, because I know you track India amongst the emerging markets packed really closely, yes. Do you think there is a possibility of a correction that could be on the cards in the near term?
Yes, I think so. I mean, India's obviously had a very, very good run, and you've obviously had the benefit of a lot of capital inflows and some optimism clearly about an improvement in the economy. But I think India faces still, as far as I can tell anyway, some significant challenges still in terms of the global pandemic. The economy is very, very weak, and obviously you're getting a lot of support for the equity market from, as you are in other countries, from the significant easing of monetary policy by the RBI, which has brought interest rates down a very long way. The rupee has been rock solid. It's not strong, but it's also not been weakening as some of the other risk markets have weakened. I don't consider India to be a risky market, but the weakness you've seen in currencies like Brazil and Turkey, especially, of course, South Africa, Russia, earlier in the year. It just didn't affect India in the same way. And similarly, as these markets have bounced dramatically in November, partly because currencies have gone up, except possibly in Russia, you've seen the Indian currency stay pretty stable as well. So India, of course, also has benefited from the fact that there are a lot of domestic growth stocks in India. There's a lot of technology. There's a lot of pharma. Obviously, the banking system's got its own challenges in India, but you don't really have a lot of cyclical stocks, at least you don't have many cyclical stocks of the sort that you have heavily in Brazil, that you have heavily in Russia, in South Africa. So I would think you're due some sort of a pause, possibly a pullback at some stage, but I would have more confidence in India doing better on a 6 to 12 month view than perhaps some of these more risky markets where I think you're going to struggle eventually until we know what the outlook is for the global economy. In other words, you've got a sort of focus in India on growth stocks, very much so, in my view, notwithstanding the financials, very similar to what you have in China. So I think you probably are due a pause, a possible pullback, but I would expect India over a 6 to 12 month period to probably outperform some of the higher risk cyclical markets that have done very well in November after, frankly, a very poor year up to November.
Right. So, Geoffrey, the other question is right now amongst emerging markets is that India was always known as the back office hub, whereas China was the manufacturing hub in emerging markets where US, European companies would always resort to. Taking the pandemic into consideration, now the anticipation is that US and European companies would shift their manufacturing base to countries like Bangladesh, Taiwan, India, taking these into consideration. Do you think this could be a great opportunity for India as well to actually become a manufacturing hub to probably not compete apples to apples with China, however, to start supplementing China at some level, at least for the first couple of years?
That is a very good question with a lot of content in it, with a lot of things that need to be said. First of all, we need to say the following, and that is with the election of President Biden, or President-elect Biden, I guess we should still say, and his ascension to office on January the 20th, I would expect to see not a reset completely of US-China trade relations, but certainly an attempt to cool things off, agree not to do more tariff increases, if you like, and gradually to try to rebuild a more stable trade relationship between the US and China. As somebody said, to treat China as a competitor, not as an enemy, whereas clearly President Trump has been treating China very much as sort of an enemy, as a zero-sum game, if you like, between the US and China. I believe the talk of shifting supply chains towards other countries in Asia, you mentioned Bangladesh, I think Vietnam should be mentioned as well in that, Sri Lanka, etc., maybe more so than Taiwan, which is such a developed economy anyway. I think that had more to do with the trade war than it had to do with the pandemic as such. Now, what the pandemic may be doing here is forcing countries to be more self-reliant, which of course is part of what President Trump's policy was all about, America, America first, made in America, etc. Now, I think the long term will be that post the pandemic, post the Trump presidency, with the Biden presidency beginning, that you will see a lot of Western companies in Europe, in the US, wanting to become less reliant on China than they've been previously. I think that's almost inevitable. So I think it will give an opportunity for some of these alternative lower wage centers, of course, in Asia to cash in on that through, building capital goods, intermediate goods for components that go into products to sell to the US. Now, India, I think, can benefit from that as well. Now, can India become a manufacturing center like China? I think that's such a big challenge. It's almost like that's gone past India now. I do think you need to see in India more, you do need to see the creation of a stronger, rephrase that, a bigger manufacturing sector as a proportion of GDP. But I think the possibility of India becoming as big a powerhouse in terms of manufacturing industry as China has become in the last 30, 40 years, I think that opportunity is probably passed India by already. And I think all you can see probably from here is marginal improvements in the marginal gains in the size of the manufacturing sector in the Indian economy. And for sure, relocation of supply chains, reordering of supply chains could well be part of that. But I think that's got as much, as I say, to do with the trade situation between the US and China, hopefully getting better over time, and what happened under the Trump presidency, as it's got to do with the pandemic. Frankly, obviously we all want to see the end of the pandemic, and that will restore more normal trade relations. But I don't think any country wants to be as dependent on a country like China for all these components and capital goods, intermediate goods, as they were before. So it presents opportunities for everybody. But whether that turns India into a massive manufacturing sector, I'm not sure. You've already got strong technology, strong pharma, strong healthcare companies. So you've got a lot of good strength anyway. But broad manufacturing of the sort that China's done, I'm not sure that's going to happen.
Right, so Geoffrey, what sectors would you recommend, especially when India is concerned right now?
Right. I mean, I as I implied earlier, I would be very careful about chasing the cyclical sectors here, notwithstanding my view that there is a global recovery coming down the road, maybe 12, 18 months away, maybe. I think the economic news, frankly, is going to get worse before it gets better, worse again before it gets better, as indeed it's about to, I think, in the US, because of this extraordinary surge of cases. And I think that's going to make it hard for some of this rotation into value and into cyclical stocks to be sustainable. In other words, the problem I have with people getting very aggressive on markets and very aggressive in their rotation to value and small cap and industrials on the back of this vaccine progress is you've got to see the vaccine progress go further, and then you've got to distribute it worldwide. This is a terrible pandemic. And if you look back at the Spanish flu of a century ago, it lasted 2 years. And we're not even close to 1 year into this yet. So I think it's going to last for a long time. So I think we're discounting economic recovery probably a little bit sooner. And given that, I would be looking to rotate back into more the growth areas, not so much the cyclical areas. So I would like technology. I would like healthcare. I would like pharma. Selectively, I think the banking system. And as you might start to see some sort of recovery in the Indian economy, perhaps selectively into some of the consumer sectors as well. But I believe commodity-related sectors are not going to have the sort of ongoing surge that they've seen in November. I think one's going to be very wary about chasing those.
Right. And very lastly, what are the key events, Geoffrey, that you would be tracking from here on to understand which way we would be heading?
Great question as well. Well, first of all, over here, we need to know how turbulent this lame duck period, this interregnum between the election and President Biden's accession to office is going to be. And clearly, the lack of cooperation between the Trump White House and the Biden transition team tells you that's probably going to be relatively turbulent. So you've got to keep an eye on that. That's one thing. I think more in the European area, we've got to keep very much an eye on, do we end up effectively with a hard Brexit? Because obviously the Brexit thing is just an endless process. I was reminding someone today that the UK voted to leave the EU before President Trump was even elected in the middle of 2016. The process is still going on. That's got to be watched very carefully. Clearly, you've got to watch the vaccine process, even if it's going to lead to I think a longer run time before you start to see sustained vaccine distribution around the world and better global economic growth. And then I think you've got to watch, above all, I think you've got to watch monetary policy. Now, I assume that we're nowhere near a situation where some of these major central banks will start to withdraw some of the support, but you've got to watch that very carefully. And that takes me back to my biggest concern, that's not my biggest concern, the biggest risk I see to markets, which is bond yields rising because you get some uptick in inflation, for example. So I'm watching the bond market very carefully. So that's an event clearly that we have to watch very carefully as well.
Absolutely. These are key events, Geoffrey, we should be watching out for as well. Thank you so much for joining us on the show. It was a pleasure to speak to you and understand great insights from your end. Thank you so much. Stay safe.
Thank you.
And a happy Diwali from India and a happy New Year as well from our side to you. Thank you so much.
Happy Diwali to you. Thank you.